When you think about the portfolios of, for example, Silicon Valley firms, like when you look at, for example, founders funds,
Sure.
there are many similarities in
Sure.
terms of what kind of people they back. They're very specific in terms of who their like founders fund personality is. Do you have anything similar in mind for what kind of people?
We're a very different firm than Founders Fund. Founders Fund does very few investments. They go extremely heavy into their investment. I would describe them as more of a thesis-driven fund.
Right.
We are not that. We also think that success can come in many different packages. I think underestimated founders are another bucket here, where it's like a founder that there's something special about them that is, they have a chip on their shoulder or whatever it is. So I wouldn't say that we have like a
Specific
recipe. I mean, we have such a large portfolio, and having been in this game for a while now, I've seen everything from the standpoint of like a founder looks like A, B, C, D. Like there's just a complete kind of variety. It's a variety pack of founders. You know, we don't probably box ourselves into a specific type. We do have a couple of types that we like, right? But it's definitely not kind of singular focus on founders that are, you know, this.
How important is a fundraising skill or selling skill is to the founders, and how important that is in your mental framework of evaluating founders?
I think that there's founders that excel at that naturally, that are very, very gifted in communication and understanding the psychology of how that works. I will say that it is not like an absolute requirement for us because it's a teachable skill. Fundraising is a teachable skill. Of course, there's certain founders that are naturally more inclined to be able to like articulate a vision and get someone excited and understand how to kind of make an investor move. But we've gotten pretty good at understanding what the anatomy of a good fundraising process looks like. And if you can't learn that, then you're not really someone we would back. So the person obviously has to have an ability to be able to learn. Speaking on the ability to learn, what I would describe as the velocity of learning is one of the biggest variables that I look at. So if we have a conversation with someone and then we talk to them 2 weeks later, there's a stark contrast from founders that are kind of stuck and other ones that are just, they're at a new stage 3 weeks later. So people that have demonstrated that ability, whether that's in products or that's in, you know, just like clarity on how the ICP evolves and design partners and whatever it is at the early days that kind of needs evolution quickly. You know, if I'm playing chess and you're a grandmaster and I'm playing and I get to move 2 times to your 1 move, regardless if you're a grandmaster, I've got a pretty good chance of beating you, even if I'm a mediocre player. That is a competitive advantage. And so it's something, a pattern that we see, you know, amongst the best founders. Now, when I say speed, I don't want to just focus only on speed. I want to focus on velocity, going back to what I said before, because you've got to be heading in the right direction too. It's the combination of speed and direction. You know, those are things that we look at.
What is the anatomy of a good fundraising process? You made me very curious about that just now.
So first of all, there's one thing that I really like. It's a quote from Abraham Lincoln, which is, if you've got 6 hours to chop down a tree, spend the first 5 sharpening the axe, okay? And then boom. And the reality is founders sometimes just go to market and they're like, they haven't thought about a systematic process. So before you go to market, and I'm talking about pre-seed, seed kind of range, right? Because that's when we come in. I think it applies to multi-stage, but there's a particular way of fundraising at the early days that's probably a little bit different than you're raising a Series B, right? The percentage of value that an investor is going to put on the quality of the person, their personal story, how they're the first hires that they're making, the team that they're building, how they articulate the market. Those are absolutely, there's 100% of the judgment that an investor's looking at when they decide to invest. That slowly becomes traction and growth, like as you move down the stack of, you know, seed, Series A, Series B, Series C, et cetera. It's about the impression and the energy you're able to generate. And so prepping and understanding, one, who the investor is, what they've invested in. I'd say that another most important things, it's basically reverse engineering some of the signal that exists. So what does that look like? There's a concept that I really like. It's called retrospective rationalization. And that's when you kind of look back and you're like, you did something really good and you're like, yeah, I did that. Like I kind of saw what that was. But the truth is, I did this, and I'm using retrospective rationalization because I didn't actually plan it. First of all, I struck out for 4 years trying to raise money, went to those 5 investors, and none of them said yes, and so I had to go back to building. And when I did finally get some success in fundraising, I was able to pinpoint the highest caliber and highest signal early believers. So I was able to get a guy by the name of Simon Baker, who built the largest, this time, property portal in Australia, you know, multi-billion-dollar company. I was able to get Mickey Malka, you know, from Ribbit, you know, this is before Ribbit. but legendary entrepreneur and hyper networks. I got a guy by the name of Greg Waldorf, who was EIR at Excel, Wences Casades. I got these names, and what I was actually doing was kind of collecting signal. And it was signal opening to downstream capital. It was signal like in terms of operating experience, like people that had built similar businesses. And so all of these things basically, I remember going to like Kazek and Monashi's and, raising our Series A at this point, which was now more like a seed round because things have changed since then. But, there was some doubts on certain things. And I'm like, look, your LPs are already investors in me, Remember like communicating that. It's like kind of easy to overcome the objection of like, look, your people that invested in your fund, they're already directly coming to me. Maybe you should also be investing in me. So I think combine that with, so kind of reverse engineering what makes sense in the eyes of an investor and understanding the psychology of how investors evaluate things. If you combine that with the calendar density, because at the early days, there's a window. If you're going out to fundraise, you did that kind of sharpening the axe. You're listing all of the potential candidates that would be good fit for what you're doing, whether that's in Brazil, Mexico, Colombia, the US, and you're lining up in a short period where you've kind of stacked them all together and you're able to go back to back in those meetings. That is one of the key elements to having a successful fundraise because you're kind of creating inertia for yourself, right? And they're not all going to say yes, they're not all going to say no, but you're at least stacking up your chances because it creates some competitive dynamics. And you combine that with having high signal people. This is basically how you execute a good fundraising in the early days.